Anyone who's been in the real estate investing sector over the last 2 years knows that it has been a difficult time, to say the least, for a lot of multifamily real estate investors. But that has also created an opportunity here for preferred equity investors to come in and issue rescue funds, basically to swoop in and grab these distressed assets that are struggling and earn huge returns with relatively low risk on that preferred equity. So to explain how this all works, we brought in data scientist Neal Bawa. He's also the founder of Grow Capitus. And his syndication companies have invested almost $1 billion in real estate with assets under management. So Neal, first of all, welcome to the show. And second of all, explain to us how this works. How do preferred equity rescue funds work in distressed multifamily?
Well, you've heard this from many people in many different ways. Extraordinary pain creates extraordinary opportunity, right? So 2.5 years ago, investors were throwing common equity, which is the at-risk equity. The bank gives you a 70% loan, then you come in with the remaining 30%. So that 30% is at risk if assets go down in value, and multifamily assets have gone down 25 to 30%. So that risk obviously is substantial, right? Well, what's happened is because those assets have gone down in value, an extraordinary opportunity has emerged, and it is called preferential equity or pref equity. And rescue funds is the other name, but essentially the mechanism used by a rescue fund is preferential equity. So what these funds are doing is they're allowing, let's say you have multifamily property and you bought it 2 or 3 years ago and the property is doing just fine. There's nothing wrong with the property. It's 95% occupied. It's doing great. But you took on a bridge loan, and that bridge loan, you assumed that when you took it on, the interest rate was 4%. Today, that interest rate is 10%, right? So your mortgage has more, or your mortgage payment has more than doubled, or more than 2.5 times. And then in the same time, we had a spike in insurance, so that there's also an increase in expenses there. We had a spike in payroll because we went
Labor
through
costs.
inflation.
Yep.
So on the cost side, you've had massive inflation. And then on the mortgage side, you've had massive inflation. Rents in the last 12 months have not risen in the United States, so they're flat, so you're not benefiting there. So now you have this really nice property that's doing everything that it was supposed to do, but you're trapped with 9 or 10% debt. So guess what you want to do? You want to refinance that property. So you want to get out of it, right? And when you're looking to get out of it, the lender says, oh, well, you bought this property for 30 million. I gave you a $20 million loan, and the rest of it was $10 million in equity. But today, the value of this property is only $21 million. So I'm not going to give you a $21 million loan. I'll give you a $16 million loan. So or $15 million loan. So for me to refinance your loan, so you can go from 10% interest rate or 9% interest rate down to 5.25 is sort of something that you can get today. Well, you pretty much have to put up $4 or $5 million. Well, the people that are in this property, the equity, are not quite happy because obviously the property hasn't distributed because its mortgage has more than doubled. And so they're not willing to put up $4 to $5 million. So a new class of investment has emerged, rescue funds that collect pref equity from investors, $100,000 at a time, and write a $5 million check to this property. Now, before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. Pref equity is an extraordinary risk-reward scenario. Because normally what happens is, how much money does a lender make for having that first 60 or 70% of the property value? They're taking very little risk, right? They're taking very little risk, and so they get compensated very little. A Fannie Mae Freddie Mac loan today is about 5.5%. And if you're going to the private market, it's about 6%, 6.5%. You can't really make more than 6.5% by being in that first position. Now, equity investors make 15%, 20%, 25%. They make more, but they take a lot more risk because they're the last 30%. Now, imagine this is a property that somebody's already purchased. You already know a lot about the property. You know a lot about its performance, and it clearly, apart from the mortgage, is performing, right? The moment it refinances, you know that there's cash flow. Why? Because you can simply take the existing mortgage and say, here's the new mortgage, and I know what the income and expenses are for the last 2 years, and boom, it goes from $30,000 bleed in a month to $90,000 profit in a month by simply changing the mortgage. All of that is very visible and very easy. Anyone can calculate it. Even the limited partners can calculate it. So in that kind of extraordinary opportunity, you come in with that $5 million and you say, I am ahead of the $10 million of equity. So in this example, $30 million price, $10 million of equity. You come in with $5 million. The bank gives you a $16 million loan. You come in with $5 million. Now at 21 million, the old loan is paid off, and maybe there's a little bit of money left over for improvements. And what has happened is, for this property, now in the future to be sold at a loss to the pref equity investors, it has to be sold for less than 21 million, which is extremely unlikely because this is unquestionably the bottom of the market. We know that properties have gone down 30%. We know that they're no longer going down. So we just saw a new cap rate analysis. Property values are not going down. And the moment interest rates start to go down, we know that these numbers will start to tick up. Maybe the property will never get back to 30 million. Maybe it'll only get back to 25. But the point is, you're in a really, really good position because you've come in as pref equity. And not only are you good from the perspective of that $10 million of equity needing to be lost before any of your money gets lost, but you're also sweeping all of the cash. You're not giving any of the cash flow to the common equity. You're saying, sorry, we bailed you out. We're not going to give you any cash flow. We're going to sweep all the cash flow. Maybe it's 8% cash flow on the 5 million. Maybe it's 9%. Maybe it's 10%. We're going to take all of it. And we still want a back end. And usually the front end is most commonly 8% cash on an annualized basis. And the back end is about 8%. 8 plus 8 is sort of the most common model. That is a phenomenal risk reward return because you're earning 16%, including 8% cash now, which you don't earn on any common equity project in the first year. I can tell you that. You're earning that because the property wasn't purchased today or yesterday. It was purchased 2 years or 3 years ago. And it already has that cash. It just needs to refinance. That is an extraordinary opportunity because all of the X factors, will this property really work? Will it gain the rents? Do you have to do the rehab? How long does it take to rehab? They're all gone. All you're doing is flipping the property from negative cash flow to positive by refinancing. That's pref equity. It is a limited time thing. All of these rescue funds are going to disappear in 24 months because there simply will be no need to rescue the properties anymore because their values will go up. And so that on this $30 million example, instead of 16, maybe the bank will give you a $19 million loan and the existing investors will put in $1 million and then you're good. So this is an industry that only exists for the next 2 years, but it is extremely compelling. And I'll say this with my hand on my heart. I have a lot of money that comes back from projects that I've sold or have been sold. Right now, 100% of my investments are in pref equity. My personal investments, all of them are in pref equity.
Oh, yeah. I mean, it's a great investing model, at least for the pref equity investors who are stepping in now with rescue funds. Not so great for the original investors, of course. But, that's why the saying goes, invest when there's blood in the
I think it's
streets,
really
right?
great for the original investors because if pref equity did not exist, the property would go back to the bank.
Well, that's
And the
true.
bank
Yeah.
is going to turn around and sell that property for the $20 million loan, which they can do in a week. I mean, there's lots of people right now willing to pay cash for that $20 million for that property. No competition, 30-day close. There's huge amounts of money floating around the market for that. So the bank's not going to bother selling the property for more than their 20 million. They'll just sell it for $20 million. Now $10 million of equity is lost. But by pref equity coming in, the property now has a chance to be run for the next 4, 5, 6 years, however long it takes, to get to the point where maybe one day it's worth 30 million. You can pay off the pref equity, you can pay off the equity. For most pref equity investments, the common equity investors will now get some of their money back instead of getting nothing back. And for some of them, they'll get all of the money back. And for a small percentage of them, they'll even make profit in the future.
So
So
I
it's
have
good
to,
for everybody. It's a win-win.
yeah, well, yeah, the original investors don't lose their money, at least not right now, which is great for them. It prolongs the investment and keeps hope alive for it.
Keeps hope alive.
I have to ask you, who are some of your favorite rescue fund operators right now? Since you said you do have a lot of your money tied up in pref equity currently.
I wouldn't want to name them because the my favorites usually have a 500,000 or $1 million minimum. And so I think most investors want to put in 50 grand. And I would suggest that you put in 50 or 100 grand when you start out. You don't fully understand pref equity. So start small. So I work with a lot of Wall Street funds. So they have, 500K minimums. Um, what I would say is that there are a number of good syndicators out there. I myself, two of my projects have had this scenario happen to them. And I'm pretty happy with the end results. So if you have a favorite syndicator, maybe that's where you start, right? So maybe you know 3 or 4 syndicators that you've invested in common equity, and maybe their common equity projects haven't done so well. But with pref equity, don't think of it that way. You're almost becoming a lender now, right? So if the project is good, if the math of the project makes a lot of sense, put money in on the pref equity side. You're taking less risk. And in my mind, you're earning a higher return because most common equity investors are not making 16% these days. They're making, 12, 13, 11% if you average it out amongst 100 deals.
Yeah, no, it makes total sense. Neal, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
We're data scientists. We have over 1,000 accredited investors that have invested with us, and we've invested 325 million of their money to either buy or build assets. Grow Capitus, the first company up there, buys assets. Mission 10K is building 10,000 rental townhomes, and you can learn about both of those at our website. We do webinars for 25,000 people a year, and they're free. And they're at Multifamily University. You can type that into Google or just type in multifamilyu.com into the browser bar.
Awesome. Well, Neal, thank you so much for joining us today. And guys, if you enjoy these quick, focused episodes that we host here on the Live Off Rents show, please rate, review the show. Makes a huge difference to us. And on that note, we will catch you on the flip side.